If you drove for DoorDash, sold on Etsy, freelanced on Fiverr, or ran any kind of side hustle last year, stop scrolling. Because there is a tax mistake that catches self-employed filers every single year. It does not involve fraud. It does not involve hiding income. It happens because people assume the federal tax rules and the state tax rules work the same way. They do not. And the penalty for that assumption is very real. In fiscal year 2024, the IRS closed over 500,000 audits and flagged more than $29 billion in additional tax. The most common trigger was not deliberate fraud. It was a simple mismatch between what taxpayers claimed and what the rules actually allow at each level. One filer tried to deduct their home office on both their federal return and their California state return. The accuracy-related penalty alone came to $5,000, before interest, before the back taxes themselves. By the end of this video, you will know which deductions apply federally, which ones your state allows independently, which ones your state blocks entirely, and the one calculation error that triggers automatic IRS accuracy penalties before a human ever reviews your return. Plus, I will show you the tool that catches these gaps before you file, so you are not discovering a $5,000 penalty after the fact. Let us get into it. Quick reminder before we go deeper. I am a tax educator, not your CPA. Everything in this video is for educational purposes only. Run these strategies by your own licensed tax professional before you file anything. Let me give you the foundation that makes all of this make sense. Are you a W-2 employee or a 1099 self-employed filer? This single question determines which deductions you can even access. W-2 employees lost the federal deduction for unreimbursed job expenses in 2017 under the Tax Cuts and Jobs Act. No home office, no work laptop. But if you file Schedule C as a DoorDash courier, Etsy seller, or freelance designer, the full business expense system is open to you, and every deduction you miss costs you money twice. For 1099 filers, the financial stakes are higher than most people realize. Self-employment tax runs 15.3% on the first $176,100 of net income. Every $1,000 in legitimate deductions you miss costs approximately $153 in self-employment tax alone, on top of income tax savings. When federal and state rules differ, confusing them does not just trigger penalties. It costs you real money you are legally allowed to keep. That is exactly what PreFile Check helps you track. Let us start with the home office deduction. Can you deduct your rent if you work from home? Yes, but only if you meet 3 requirements simultaneously. First, exclusive use. The space is used only for business. A desk in your bedroom, where you also watch television, does not qualify. Second, regular use. Consistent ongoing activity in that space. Third, it must be your principal place of business. Miss any one of these and the entire deduction goes away. 2 methods to calculate the home office deduction. Simplified. $5 per square foot, up to 300 square feet, maximum $1,500 per year. Regular method. Divide your office square footage by total home footage. On a 200 square foot office in a 1,800 square foot home, that is 11.1%. Apply that percentage to $24,000 in annual rent and you get $2,664. Compare that to the simplified method's $1,500. The regular method nearly doubles the deduction. Run both numbers before you choose. Here is the red flag that generated the $5,000 penalty from the opening. W-2 employees cannot claim the home office deduction federally. It was eliminated under the Tax Cuts and Jobs Act and stays eliminated through at least 2025. If you receive a W-2 from your employer and tried to claim a home office on your federal return, the IRS automated matching system will flag that return, not a maybe, a near certain penalty notice. The standard business mileage rate changes every year. In 2026, it is 72.5 cents per mile, up from 70 cents in 2025 and 67 cents in 2024. For a DoorDash driver logging 8,000 business miles in 2026, that is a $5,800 federal deduction for mileage alone, but every single mile must be documented with the date, the destination, and the business purpose. The IRS disallows undocumented mileage claims under audit, all of them, no partial credit. The question is not whether you can claim your mileage. The question is, can you defend it? The IRS requires a contemporaneous mileage log. You document each trip when it happens, not 6 months later when you are preparing your return. Apps like MileIQ or Everlance auto-log trips with timestamps and GPS data. If you drive for work and are not using one of these, you are carrying deduction risk you do not need to carry. No documentation means it did not happen. Business meals are deductible at 50% of actual cost. You or an employee must be present. There must be a clear business purpose, and the meal cannot be extravagant. Simple enough. But here's the 2026 change many business owners are missing. Employer-provided meals for employee convenience become fully non-deductible starting this year under the One Big Beautiful Bill Act. If your business has been deducting employee meal costs, that benefit disappears in 2026. Check your books and update your expense categories now. Here's where the double-dipping danger lives. Every state with an income tax decides how closely it follows the federal tax code. Some adopt federal changes automatically. Others are frozen to a specific date and need their own legislation to update. California was operating under a conformity date from 2015 until a state law updated it to January 2025, nearly a decade out of sync. Assuming your state return mirrors, your federal return is exactly how costly errors enter. The SALT deduction is a clear example. SALT is state and local taxes. The federal cap increased to $40,000 for households under $500,000 in income for 2025 and 2026. That is federal only. Many states have no equivalent cap. New York still uses pre-2017 rules, meaning New York filers can itemize on their state return even when they take the federal standard deduction. That is not double dipping, that is two separate rule systems. The one that trips up equipment buyers most is bonus depreciation. Federally, you can deduct 100% of qualifying equipment in year first, buy $80,000 in equipment, and write it all off this year. But approximately 17 states do not conform, including California. In a decoupled state, that $80,000 federal deduction might allow only $16,000 in year first. That is a $64,000 taxable income gap. If you did not plan for it, you owe state tax on money you thought was already written off. State-level conformity and depreciation rules get complicated fast, depending on your situation. Definitely loop in your tax professional before applying any of this to your own return. And if you want to track your deductions at each level before you hand things off to your CPA, that is exactly what PreFile Check was built for. It organizes your expenses by category and flags where your state rules differ from your federal filing. That review can catch a costly error before it becomes one. Let us put real numbers on this. Scenario 1. A W-2 employee incorrectly claims a $15,000 home office deduction on their federal return. In the 22% tax bracket, that is $3,300 in underpaid tax. The IRS accuracy-related penalty adds another $660 on top of that. They now owe $3,960 before interest for a deduction they were never entitled to claim in the first place. This is not a trap. This is the rule, operating exactly as written. Scenario 2. An equipment buyer takes 100% federal bonus depreciation on $50,000 of equipment, then copies that number onto their state return. But the state only allows $10,000 in year first. That is a $40,000 excess deduction at the state level. Additional state liability plus penalty could run anywhere from $4,000 to $8,000, not because they lied, because they assumed federal equals state. These two scenarios represent the most predictable and preventable tax penalties in the Schedule C world. 5 rules to protect yourself. 1. Treat federal and state as completely separate calculations. Do not assume they match. 2. If you live in one of the 9 states with no individual income tax, including Texas, Florida, or Nevada, the double-dipping risk does not apply to you. 3. Document every expense when it happens, not when you file. 4. Run both home office methods every year and choose the larger deduction. 5. Check your state's bonus depreciation conformity before buying major equipment. One principle ties every deduction strategy together: the iron wall rule. Every business expense lives or dies on its documentation. No receipt means no deduction. No mileage log means no mileage deduction. No record of who attended a business meal, and what you discussed means the IRS will disallow that meal, even if it genuinely was business. The difference between aggressive and illegal is almost always documentation. Show your work, and you can defend your deduction. To do this correctly, your books need to be clean before you hand anything to your CPA. QuickBooks Self-Employed Auto categorizes transactions and exports Schedule C data directly. Wave is a free alternative that handles invoicing and expense tracking. For a dedicated pre-filing checkpoint built for Schedule C filers, PreFileCheck.com walks you through deductions category by category, flags documentation gaps, and notes where your state rules differ from federal. That is the review that prevents a $5,000 penalty. Before you file, one question: Are you treating your federal return and your state return as two separate calculations, or are you copying numbers from one to the other? Drop your answer in the comments. Federal and state separate or same numbers? And if this breakdown helped, hit subscribe. Every week, this channel breaks down the actual IRS rules that 1099 filers need to know, not the generic advice, not the TikTok shortcuts, the real rules.